Good morning. I'm Mike Cody, editor of New Hampshire Business Review. Welcome to Hot Topics and Transactions, sponsored by Sheehan Phinney. Our panel today includes Eric Collins, who is a shareholder and corporate attorney at Sheehan Phinney, Emily Peniskovic, who's a shareholder and corporate attorney at Sheehan Phinney, Bill Stewart, founder of First Street, and Karen Gregory, co-founder and managing partner of Blue Highway Growth Capital. Welcome.
Thank you.
Thank you. Thank you for having us.
Thanks, Mike. I'll go ahead and kick things off here. So, as Mike mentioned, I'm Emily Peniskovic. I'm a corporate attorney. So, I work with businesses at all stages, from the earliest growth and capital raising stages through restructurings, and then eventually at the exit and M&A stage. And in M&A transactions, I work with companies on both the buy and sell side. And I'll let Eric do a quick introduction as well.
Certainly, yeah, very similarly, I'm a corporate attorney that works with companies from formation through exit and on the exit side, both sellers and buyers in a variety of industries, either manufacturing, tech, biotech, and service-based industries.
Excellent. So today's conversation, we are bringing together two different complementary perspectives on the lower and middle market M&A trends that we're seeing. And I'll let our panelists do their own self-introductions in a second here. But just at a really high level, we have Bill Stewart, who helps entrepreneurs and sellers prepare for and execute one of the biggest transactions that they'll see in their career. And we have Karen Gregory, who helps deploy growth capital and partners with companies as they enter their next chapter. So together, they see these deals from opposite sides of the table in some cases, and that's where some of the most interesting insights emerge. So it'll be good to hear both perspectives here, and Eric and I will be keeping the conversation moving as well. So we're here to discuss the current M&A market for the lower middle market and some of the forces that are shaping the market today. So we'll be hearing these perspectives from both sides of the table, understanding how expectations might be evolving, where there are opportunities in the current environment, and most importantly, what it's taking to get a deal done and over the finish line these days. So whether you're a business owner that's considering a sale, or an investor that's seeking opportunities, or an advisor that works with clients on either side, hopefully this discussion will provide some practical insights into some of the trends, challenges, and opportunities that the M&A market is facing today for lower middle market and what might lie ahead. So with that, Bill, why don't I have you go ahead and kick us off with a little bit about yourself?
Sure, thanks. So I'm Bill Stewart. My company is First Street. Good morning to everybody, both here and out there virtually. Appreciate it. Appreciate Emily and Eric asking me to participate. This is a great venue to kind of get some information out there and hopefully help some business owners and others. And also thanks for New Hampshire Business Review for hosting. Appreciate it. So I'm a managing director at First Street Business Brokers and First Street Acquisitions. We're based in Portsmouth, New Hampshire. We provide sell side and buy side advisory services to small and lower middle market companies. A little bit about me. I come from a finance background originally. I was in banking and corporate finance with JP Morgan Chase down in New York, doing private banking, middle market transactions. Following that, I founded a couple of different companies, and I've sold those before starting Stewart Search. First Street. Stewart Search was one of those before founding First Street. And so I've sat on both sides of the table. So we bring a lot of that expertise when we work with small companies. We understand what it took to found them, grow them, work inside them, and then subsequently sell them, and what that exit looks like for someone participating in it and some of the owners. So that's a little bit about my background. We provide a full range of advisory services, from valuation to preparing for transaction to identifying the right buyers and qualifying them. We run a competitive process, and then we work to negotiate the sale, both with the owners and the buyers. And we do that with kind of two lenses. One is always, what is the owner's outcome that they're looking for, whether that's a legacy sale or something where they want that business to really continue and their employees to be safe and in a good environment, maximizing purchase price. All of those factors kind of come into play with these types of transactions. And so we spend a lot of time working with owners, kind of preparing for that and understanding what they're trying to achieve and what their outcomes look like. So that's a little bit about me and our firm and what we do. So,
Thanks, Bill. And
yeah.
Karen.
Hi, good morning, everyone. Thanks to the New Hampshire Business Review for hosting this and for Eric and Emily for coordinating it and asking me to participate as well. I'm excited about today's topic. So I am a co-founder and managing partner with Blue Highway Growth Capital. We are a private equity fund, and we make investments in companies that are 5 to 50 million in revenue, that are profitable, that are seeking to grow for a variety of reasons. It could just be a new market they're pursuing. There could be one of the founders that would like to exit, and we can provide that capital to help in that exit. They may be working with Bill to prepare for a sale, and they're not quite ready, and they need some capital to grow a little bit more to be able to be more market ready. So that's a little bit about Blue Highway. We've been in business for 10 years. We have about 150 million under management. And I'm a business lawyer by training and have worked primarily in the earlier stage company formation, doing work that such as Eric and Emily does through a law firm that I co-founded 20 years ago called Furman Gregory Deptula. So I've seen it from the legal side, and I've been right in the midst of it as an investor as well. So it's an interesting times to be investing in lower middle market companies, I would say. So
Great.
thanks.
Thank you. And just one quick housekeeping matter. If anyone in the audience does have questions, there is a Q&A box. So we definitely encourage people to submit questions throughout the panel, and we'll try and weave them in as we go here. We'll also try and reserve a bit of time at the end to answer any lingering questions, but please go ahead and take advantage of that if any pressing questions come to mind. And with that, I'll turn it over to Eric.
Great. Thank you, Emily, and thank you, Bill and Karen, for your introductions and summaries. And thank you to New Hampshire Business Review for hosting today. We decided to break this topic up into a couple of different tranches, 3 different tranches. One, we want to talk about the market overview. And there's some anecdotal evidence out there, but there's also some data showing that lower middle market deal volume fell about 25% when you compare Q3 2025 to Q3 2024. And I'm curious, Bill, if you've seen that type of reduction in deal activity in the first quarter or second quarter of 2026, and what maybe you relate that to. Is that because of the macroeconomic activity or just general uncertainty? Curious your perspective on that.
Yeah, and thanks. That's probably one of the one of the questions we hear most is, what's happening now in the market? What happened last year? Where are we? So, yeah, I'll just tell you a little from our perspective. 2025, the latter half of 25 was kind of a complicated market. Obviously, we had a government shutdown, we had rate increases, there was significant uncertainty, and what it did, it caused a lot of pullback. Everybody just kind of pulled back, whether it was banks pulling back, whether it was buyers slowing down and saying they weren't clear as to what was going to happen. Sellers just uncertain, rate environment going up, valuations coming down. So there was a lot of that, and so we did see deals. We didn't necessarily see too many deals pulled from the market, but everything was kind of delayed or put on hold. There was a pause button at the end of 25. What we're seeing the first quarter and first half of 26 is I can speak from our experience first, I guess, is we closed a lot of those deals that were kind of paused in 25. So we've actually seen a very significant and robust first half of 26, both with the pent up deals that we're trying to finish in 25 and couldn't or didn't want to. And then we're also seeing a renewed interest from sellers who, I think some of this uncertainty in the macro environment, I think people are realizing it's going to be uncertain for a few number of years forward, whether that's two, three, or whatever that looks like. So I think, now we're able to kind of, at least the rate environment, people are starting to understand it a little bit better. Um, Overall macro, there's still all that fluctuation, whether, related to the macro environment. But I think sellers are starting to understand, and we're able to coach them through kind of what a sale looks like in this current environment. So we now have some traction. We now have some experience with the current trends, and we can talk to what that looks like and deal with the issues at hand. So overall, 25, 26 is a much better market than it was in 25. And I think even though it's still unstable, I think we're seeing some ways to manage through it. And the financing component is more stable than it was at the end of 25. So we're seeing good transactions happening this year.
That's great. Thank you for that feedback. So it sounds like there's a lot of certainty around the uncertainty going forward. Karen, what's been your experience at Blue Highway?
So in 25, we actually had two strategic exits. So we sold to two buyers that were looking at our portfolio companies for their technology, for their assets. And in one case, the company had been a customer of our portfolio company, and it wasn't anticipated that they weren't looking to be bought at the particular time. And neither of them actually were. One had been talking to a particular buyer for a while, but I would say in neither case was there any delay based on sort of the market uncertainty or the lack of financing for the buyers. Again, they were strategic, so they were in the industries in which, our two companies were in. So they, I think, had their eye on these companies, and they were trying to consolidate their resources. In the one case, it was a customer that is a international company, and the reasoning behind the sale was they said we need to control the U.S. domestic supply chain. We see what's going on worldwide and in the US, and we can't run our business unless we control our supply chain. So they purchased our company, which was a key piece of their supply chain, and it now basically made it their own, which was actually very interesting. So they saw some of the trends, like around the tariffs and some of the supply chain disruptions that do continue, but that's actually the reason that drove them to buy the company, as opposed to walking away. So we had a little bit of, we were somewhat surprised. And again, to Bill's point, I mean, we certainly were seeing, in large part looking at deals that companies were more reluctant to take in equity last year, and were kind of taking their time around even refinancing with a senior lender. So we certainly saw what Bill's talking about, but in those two particular instances, we actually, got good results around, and again, I think it's different if you look at financial buyers versus strategic buyers.
And on those strategic buyers, are you seeing more like balance sheet acquisitions, or are they leveraging combination of both?
Yeah, they're asset purchase agreements. So they're basically just looking for the assets, the inventory, the customer base. In both cases, they were just looking to really kind of look at leveraging and knowing that they could eliminate a lot of G&A because they were bigger organizations. So they were really more focused on, where could they add value, either around sales and marketing or production and operations, because they had bigger facilities that they could tuck some of these products and people into in their own organization. So I think they saw that, from a perspective, they could probably run the company more efficiently. And so again, it was really looking at, they were really more interested in sort of, I think, where they could take the company, and not isn't necessarily looking, kind of on the valuation question, which I know we'll get to later on to talk about how that impacts these transactions.
And so they're creating their own certainty in some aspects,
Exactly.
right?
Exactly
Problem
right.
solving for that, yeah.
Right.
Ingenuity at its best. So if we're seeing some of those strategic acquisitions, problem solving for the uncertainty, or either an abatement of the fear that was once present because of market uncertainty, what are new challenges that are emerging now in Q2 heading into Q3 of 2026? Are you seeing changes from that perspective at the end of 2025? If so, what do those changes look like?
Do you want that?
Bill, sure.
Oh,
We'll start with Karen, then we'll
okay.
feedback.
All right.
Thanks.
So I think, we are still seeing an interesting undercurrent around senior financing, senior debt financing. I think that the traditional commercial lenders, they're highly regulated, and they are often, we're finding, at least in our portfolio, that they're not willing to necessarily increase availability. They're very much, holding down, to their, worried that the company might just be tripping a covenant. So we're seeing a lot of private credit funds come into the marketplace, a lot of alternative financing sources, which might be shorter term, in both cases, somewhat unregulated and very expensive forms of debt financing anyway, that usually sits ahead of us in the equity on the balance sheet, in the equity category. So we're seeing that some companies are still, they want to refinance either to get more availability. We are seeing actually an increase in sale leasebacks as a form of being able to get some
Hmm,
capital to liquidate, an asset that they're sitting on, and basically being able to sell their underlying real estate and then just having it leased back and, paying
hmm.
a lower rate. And, the cost of capital there is a little more efficient for some, especially on the manufacturing side. And that's where we do a lot of our investing.
Interesting. Thank you. Bill, agree, disagree, different?
Yeah, I think a couple things. One is we are seeing the senior market improve. Banks are willing to put more money out now than they had been at the end of 25, certainly. So we are seeing that from our perspective. SBA lenders are lending into it, and some senior bank debt. We do find that we have to deal with some of the issues through structuring. So there are often gaps between either valuations or seller expectations that we're trying to sort out, that can't be managed with senior debt, as I think Karen was kind of alluding to, and the need for some of this either gap financing through equity with a firm like Karen's, or um, different ways to access that or structure it through seller notes, earnouts, a variety of different options that we are talking to sellers about, more so than maybe we were historically when debt financing was cheaper and easier to kind of put on the balance sheet. So we are getting much more involved in active structuring and working with sellers to provide gap financing or finding equity partners outside to provide that gap financing between what we view as a valuation gap, if you will. Um, so yes, I guess to answer the question, we are seeing similar kind of trends. You just have to, if you work with an advisor like us, like First Street, I mean, that's part of the advantages of what we do is how we structure a transaction with the buyer. We can bring buyers and sellers together and kind of bridge that gap with a variety of solutions.
Thanks. And so from a thematic standpoint, we're looking at valuation gaps. We haven't really touched on diligence yet, but economic uncertainty, it seems like those are some hot button issues that create weakness in the structure of an exit or an acquisition these days. Are there other challenges, or what might separate deals that close versus deals that just fall apart in 2026?
Yeah, and I think what we see is deals that kind of come apart usually come off of a few different buckets. One is there's either a seller that might be anchored in a number that they have, a valuation number that they have in their own mind, or they want to stick to when they go to market, so they don't have as much flexibility, and that can be cash at close, or that can be the overall purchase price. But or they get, because what happens is they view their company and they've heard a value is X, whether it's AI generated, an accountant generated, however they develop that value. One of the things that we run into is that where the valuation doesn't take into account how much it relies on the individual owner that will be exiting. So what they're contributing to the business and how that person's going to be replaced. Um, we run into kind of unclean books and diligence or different things like that. So those can cause problems. So we try and head off all of these problems, obviously, in advance. But what we'll run into is diligence surprises, someone anchored in a value that's not realistic because they're not thinking about themselves exiting the business or things like that. And then also we're running into working capital as much more of a driver now than it had been. Obviously, everybody looks for some working capital peg, but we're really finding that buyers are pushing hard on trying to get a fair amount of working capital. And sellers' expectations are with an asset sale that they're going to walk out with all the cash, all the receivables, and get paid for their inventory. And
Mhm.
we're seeing a lot more pushback from buyers who are saying, "Hey, look, I get it, but we're paying the ongoing business value for this. We should get a fair amount of working capital in this transaction as well." And so that's one thing that we have to work through often is that working capital peg, and we try and do it right up at the LOI phase so we don't run into too many issues farther down the road. But those are some of the issues and uncertainty that we're seeing in deals. It seems like those are the things that crop up the most. So we really try and manage those on the front end in our conversations with sellers.
It's fair to say though that preparation is key way in advance of the term sheet, just structuring the deal from the seller's perspective in case you were talking about, but also from the buyer's perspective if you're looking at a strategic acquisition, how that's going to work out. And I'm sure we'll touch on preparation being key way in advance. These deals don't turn on a dime
Yeah.
by any stretch of the imagination. So Karen, from Blue Highway is kind of focused on providing growth capital in rural areas of
Right.
throughout New England. Have you seen a different or experienced different challenges in the small business rural market or lower middle market rural market from Blue Highway's perspective?
Well, I think there's always a notion that if the company's in a rural area, it's probably doesn't have a lot of growth prospects if you're looking at it from the buyer's perspective. And we often, we'll hear a buyer say, well, I'd have to move the company, or I have to look at these issues as it relates to, well, I'm headquartered in Maryland, and do I have a company based in Vermont? Is that going to help me or is that going to hurt me? I like what they're doing and I like the products and the customers, but do I have to move them? And do I have to think about then I have no employees because half of them probably won't move. So there's some of those issues I think that we hear about rural companies, but you don't hear if you're outside of Boston or Philadelphia because there's just a presumption that there's not enough workforce to scale the business in that location. I think in the two examples of our strategic sales last year, the opposite was the case. The company that bought the Vermont company actually increased the workforce in Vermont, brought up some of their lines of business because they had Canadian customers and it was actually better cost for transportation, for instance, is the reason that they did that. In the case of the West Coast company that was bought by a very large international strategic, they're tripling the workforce and taking on even more facilities because, again, they're making it their own. They're going to have they're having a captive supplier. So we've actually been pleasantly surprised that we haven't seen companies get purchased and then dragged out of rural locations. I mean, we have an impact story we'd like to tell that we're trying to create jobs and sustain rural communities. But, when it comes to just the pure dollars and cents, I think we're not seeing any particular, no one's saying, well, we're discounting this company because of its location, for instance. So I think, what we're trying to avoid are earnouts. because oftentimes they don't want to keep the people who are in the company in the senior leadership anyway. And so then you have no control over things. But I would say it's more of a misnomer that there's disparity between, a company in rural locations getting sold from one that's, again, outside of Boston. So I think we've had so far good experiences. We've only exited out of 4 companies. So we'll see. We've got, but I do think that it's somewhat unique, again, in the perspective of a buyer. Do companies, I mean, Bill, his job is obviously to find the buyers, whether they're looking for the company in the middle of, Bodenham, Maine, or whether they're actually, looking for the company. They're looking obviously for something about the company, the assets, the customer base, the expertise of the company's skill set. So we haven't necessarily noticed anything different. I think which is great, which is great.
No, that's fantastic. In relation to the strategic acquisitions or sales that you're talking about, exits, we had a question about communication and how the communication to employees, to strategic customers about the transaction folds in to the planning and preparation and closing of the transaction. What's been your experience in getting communication professionals involved in those 2 deals, for example? When were they involved? How was communication made to the employees in the case where they're growing the workforce 3x? I mean, that's a significant growth. Typically, employees are worried that they're going to be on the chopping block in a transaction like that. So those are great stories.
Right.
But there's also, a lot of good behind the reasons for those strategic acquisitions, and communicating that to the employees and customers so that you can preserve that value is important. What was your experience in those
And
2 particular transactions?
it was a great question that I saw yesterday when it came through, and it's very tricky because depending on the nature of the buyer, if they're a private company versus a public company, there are certain rules that the public company has to be mindful of as they're going into some of this transaction. You don't want to do it too early because before the transaction looks like it's going to take place. You also don't want, you want to feed what I call feed the rumor mill, because you don't want, if somebody's walking around the plant a lot and you're saying, who are those people? What are they doing? And the employees start to spin stories as to what's going on. Are we being sold? That sort of thing. Even when we come in and are considering an investment, we basically, the owners are saying, well, we're looking for growth, we're growing the company, so sometimes what the seller will say is, we're pursuing opportunities to grow the company. And that usually generally, pretty vague, but, puts the employees at ease, because that doesn't, who knows who these people are walking around. I mean, they could be investors, they could be a new bank, they could be, so you try to do that to, keep people from running out the door. But I think it's, having somebody who understands strategic communications to come in, I think certainly past the LOI. I mean, you really have to be, I'd say you're in definitive legal documentation, and then you're preparing like a press release and all of those things. But again, you have to be careful about who the buyer is, because they have to have their own cadence about, when they release. Like, for instance, the company on the West Coast, they're a large international publicly traded company. They're the ones that, set the cadence for putting out the press release and saying what they were going to say, because they had to make some public disclosures as well.
Oh, that makes sense. Bill, any thoughts on that?
Yeah, actually, that is a great question. We deal with it all the time. When do you tell employees, when do you announce this, or how do you handle this with customers? So a lot of our acquisitions are strategic buyers as well. I mean, because of where we are in the market, the size of the companies we deal with, there really isn't PE per se. I call it small PE maybe, or, there's some family office, but we definitely have individual buyers, and we have a lot of strategic buyers who are buying ours. And they're often private companies, to Karen's point. So We deal with this all the time and how to manage communication. And I had actually had kind of a coaching. I've always worked in the middle market space, and we had a coaching firm that focused on communication to employees and performance and some of the human capital elements. So we do a fair amount of work with our sellers on when to roll that out, when to communicate to employees, and what that might look like. And that can vary depending on the type of company. As Karen mentioned, bringing in a partner or a way to grow. We're looking at opportunities for growth. And so oftentimes they'll talk about it as bringing in a partner and transitioning out rather than, just a forthright sale where everybody gets nervous and says, my job going away, what do I do? Do I start looking
Mm,
now?
Mhm.
So we spend a fair amount of time talking through those. And same with customers. And you also don't want competitors finding out because they'll try and poach your staff.
Mhm.
They'll try and poach your clients. Hey, they're being sold. You should be working with us, not with them. So there's a fair amount around confidentiality and how that process rolls out to protect both the business, the employees, and the seller. And so it is a big part of the process. And we do bring in external communication firms if necessary. But, we do spend, I would say that's a good chunk of conversations we have with sellers throughout the process. And it is later in due diligence. We like to make sure that we have confirmed financing. They've already gone through most of their preliminary due diligence and things are pretty solidified and we're close to or at definitive agreements like we're talking about, like Karen was talking about, before it really rolls out to anybody if we can help it.
And I think the other piece of that is, I mean, oftentimes, in the transaction, you're ultimately asking the buyer for a list of employees that they've done, on the diligence side, they may have in mind, okay, there's 45 people, we're probably going to keep 40 of them. Again, they look at the G&A, they're going to not keep the controller, the accounts payable clerk. I mean, things like that where they can bring all that in-house. So you sort of assume eventually, and at least in our experience, they'll say to the seller, you'll have to get rid of those people. I mean, that we're not going to come in and do that. Like that's on you. You have those conversations sometimes ahead of time so that, maybe they'll keep them for 3 months or something just in a transition, but there's usually people on the list who they're not going to keep because it's duplicative with their own infrastructure. But again, I think the key also is not, is communication with the buyer to make sure that the seller is understanding what the buyer wants to get out. I mean, they don't
mm,
want to have people run out the door, but they also have to, there's a balance also, to make sure that the buyer understands, well, we're going to communicate this usually when it's done, when it's closed, but how do you communicate it is one thing, but what are you saying? What are you
mm,
saying in the meantime? And just making sure the buyer's not surprised that a few people they hoped to have in the mix when they bought the company have left.
mm.
I mean, they're not indentured servants. You can't keep them in the business, but you can at least, I think that's I think that's when it doesn't go well, it's when there really isn't a lot of communication between the buyer and seller on this topic either.
Sure, and to the extent that the individuals you're talking about are non-equity owners in the business, it can have a really meaningful impact on the
Mhm.
going concern value of the company post closing. So, one last question for this segment, I just want to try to be succinct. Is so for business owners, executives that are in the audience, and they're thinking about a transaction in the next 12 to 24 months. Whether that's let's focus on the sell side. What is one thing that you would say to each of them to prioritize for that transaction in the next 12 to 24 months? Bill, we'll start off with you.
Oh, yeah,
Okay.
go ahead, Bill.
Yeah, I mean, that's obviously a good question, and it's critical to kind of start early and focus on it if it's something you're going to do. So, it's interesting. It's funny. I was thinking about this question, and I was talking to someone in my office the other day, and I was thinking about when I was teaching my kids to drive, right, or to drive a boat, drive a car, anything, right? I was talking to them about. I was saying one of the things that I used to tell them is, there's going to be distractions. There's going to be stuff happening. You're thinking about, there's people blaring music, they're spilling soda in the car, whatever it is, right? And the one thing I always told them is just remember, always drive the car, right? Don't get distracted by all these things that are happening in the car, around the car, what's happening. Ultimately, you have to drive the car, right? Because you don't want to be hitting something else. You got to drive the car. So that was always kind of a theme. And I think that's important in this. So when people start thinking about transition and they think about, oh, they're going to be transitioning away from the business and stuff, I always tell them keep focusing on the things that made you super successful. Keep focusing on the things that brought your business to where it is today. Continue to run the business as if you're running it forever and you're growing it and you're doing it. Because if you take your foot off the gas and stop focusing on those customers or let things start to slip, it shows up in the numbers, it shows up in the diligence, and then you have a problem that you don't want, right? You want to be in full mode when you go to sale. So that's one thing. Obviously, that's just an overarching kind of theme. I do think that there are some things that really kill deals. I mean, you got to really look at your financial statements and kind of see like, how are we? Are we in order? What's happening? Are there things that we should clean up to get those in order? If there's any add backs, are they consistent? Is everything structured correctly
Mm.
on our financial statements so that when we present them, they're clean? Same thing with operations. You want to have your manuals in place. You want to have documented process. You want to have those things kind of cleaned up. So there is probably a four bucket, four or five. I mean, you could make it 10, but there's probably four or five good buckets of areas that every company should just run through a quick little diligence on themselves. And we'll provide that kind of information as we start working with someone, so they know what to focus on. The other thing is I would say don't start negotiating with buyers or talking to individual buyers without talking to an advisor first, because there's a lot of mistakes that get made early and they're hard to pull back from once those
Mm.
conversations happen. And they and it can result in a scenario that would have been a great buyer and a great situation happening. Um, had it been done in the right order, it would have helped a lot. So
And Bill,
I don't
just
know if
to
that
add
gives
to
anything
your
definitive. I can get into more like detailed things, but I think that gives an overview of my thoughts on it.
Bill, just to add to what you just said, because we get this question a lot on the legal side, is, when should we call a lawyer if we're thinking about selling? And to your point, I mean, my advice is always like, it can't come early enough. In other
Mm.
words, to the extent you can get ahead of that diligence a year plus before you're even thinking about a sale so that your house is in order and you're not scrambling when you get a due diligence checklist from buyer to do that cleanup. It's always ideal. And to your point, talking to advisors like First Street about, how should we be thinking about structuring the transaction? What are the different options? I think what's tough on our end on the legal side is when a client comes to us, like, this usually comes up with new clients to us and they've already signed an LOI. And to your point, Bill, it's
Yeah.
really hard to go back from that. And I think people who have never sold a business before see, oh, it's a non-binding LOI. It's not going to bind me. It's okay. I can just sign it to keep things moving and then I'll go
Right.
and engage the attorney. And I just can't reiterate enough that it's never too early to just start talking to advisors if you're really thinking about a sale.
Emily,
Yeah,
I
I
think
think
you're so right. I think that, I think business owners think, oh, well, this is simple, you know, especially if it's a customer that's coming, and they've had this relationship for a long time. I think sometimes, we'll see that and it's this, comfortable relationship, but it's a different relationship. It's they're buying my product and now all of a sudden they're going to buy my company. And that's a whole different level. So hopefully business owners have good attorneys at their side all the time. They're not just waiting till they have a transaction. But, for us, whether we're investing in the business or helping, on the exit side, we're going to do a quality of earnings or the buyer's going to do a quality of earnings. So again, it really comes down to not only, making sure you can stand behind your numbers,
Mm.
that, again, that you don't have a lot of weird add backs, adjustments in the EBITDA column. A lot of family-owned businesses, it's pretty complicated because they'll buy the cars and the trucks and they'll have a lot of assets that they've kind of commingled. And so, having that together, since a lot of businesses don't always have a board of any sort. I mean, that's part of what we do when we come in and make an investment is we create a 3-person board, to provide some governance and oversight. But to the extent that they don't have that, at least, thinking about what that looks like, I think it's really important, because this is for them to, this is sort of more on the emotional side, but to not have a regret, to really think about and really work with your advisory team about, why do I want to sell this business? What are my drivers of selling the business? And again, sometimes it's because, one of my co-founders wants out and I can't buy him out. So how do I get out? So I guess we just have to both sell. Again, that's where growth equity can come in, where you can actually substitute. We can help you fund out the other owner and, give you capital to grow the business without him or her into a point where they're actually, they're in a better position. But I do think, and the other thing, again, being lawyers, making sure there's no skeletons in the closet, a former owner that now comes back and says, oh, look, they're selling the business. Oh, I must have stock certificate around here somewhere that I didn't cancel, or, a disgruntled employee that you really didn't have a lawsuit around and they kind of went away. They never signed a release. I do a lot of the legal diligence and the intellectual property diligence. That's another thing, is sort of, have you really managed, if you have trade secrets, are you really managing those secrets? What is, because again, the buyer is going to come in thinking, oh, great, I've got this great IP portfolio. And then they find out, oh, you didn't protect it. You didn't enforce. You've got competitors all over the place are using your technology and you didn't bother to even send them a letter. Type of thing. So those are the kinds of gotchas that we see coming in, either as an investment or making sure that our companies on the way out have buttoned up some of those things.
So
Yeah,
let me just jump in one more thing on that. I was just thinking about it, and I think all of that's right. I mean, one of the things that we didn't talk about, but I think is super important to get done early too, is a good market valuation, to kind of understand what the value of the company is today and what are those drivers in the valuation, so that they can look at ways to maximize profitability in that exit, whether it's a year or 2 years down the road. So, and a good market valuation, not necessarily a rule of thumb multiples. You really want someone to kind of pour through and take a look at what's driving the valuation and how that works. And we do a fair amount of that up front, which I think is super helpful. I also think one other thing that I didn't mention that I should, is owner dependence, right? How reliant it is. And I mentioned this earlier in our conversation, but to the extent that they can look at ways to support their staff and grow their staff into positions that once they vacate the company, it's much more sustainable once they leave. That's a real concern of buyers, is just, how sustainable. Obviously, a strategic, a little less so, but certainly a financial buyer or people like that are certainly looking at ways to, sustain that company and grow that company, and how the current staffing levels can kind of elevate the company or bring it to that level. So, I would just note a couple of those things too.
So I want to just hone in on a few of the topics that came up in that more generalized overview that I think are on a lot of people's minds when they're thinking about selling their companies. So one is, who are the active buyers, and how does the deal get financed? Those have been some of the major factors that have shifted over the past year or two. So I guess just to start on the buyer landscape piece, over the last year or two, we saw somewhat of a decrease in private equity transactions and, an uptick in strategic acquisitions. What have you been seeing in terms of how that pool has shifted, specifically in the lower middle market so far this year? Bill, I know you mentioned in general your clients have a lot of strategic buyers, and obviously, Karen, you bring the private equity perspective, but I guess, have you seen any shifts in the first, half of this year? And is one type of buyer, either strategic or PE, more active currently? Bill, why don't you kick us off here?
Yeah, I mean, we're definitely seeing strategics in the market trying to gain market share, organic growth. There's depending on the industry, has been tough, and it's tough to find staff and the like. And one way
Mm,
to achieve that growth and that staffing levels and the like is through an acquisition. So we're definitely seeing strategics are more active, or are definitely active in that space. They've always been active in the space, but I find them even more active right now. They're really trying to kind of achieve staff levels and growth levels that some of the organic growth isn't there. They can get it through pricing, but they're not getting it through customer acquisition. So they're
mm,
they're looking at doing it that way. Um, so we are seeing a pretty active strategic market. We are seeing, it's interesting. We're seeing what I call them little PE. I don't know that there's a term for it, but it's not the bigger PE players, but it's smaller PEs or smaller funds are looking to uh, deal more in our market, which is this lower middle market, emerging middle market, and even some of the Main Street businesses. We're starting to see, they're rolling up a handful of those. And so they are coming down into where we historically didn't see as much PE. We'd see a family office, we'd see individual investors or some smaller group investors. Now
mm,
we're seeing this, what I call little PE buyer groups that are coming into the space, and they're almost looking like strategics because they'll buy one as the platform the way a normal PE would, but they're a small company platform, and they'll cobble together some smaller companies rather than they're not looking for rapid acquisition and then a sale fast. They're looking at
mm,
more acquisition and continuing to grow through acquisition, but a hold strategy longer than we've seen in what would be a traditional PE. We're starting to see
mm,
they want to hold for 10 years, or they want to hold for a while
mm,
longer. And so we're seeing more players that are doing that. Um,
Interesting. A bit of a hybrid model.
yeah, it's kind of a
mm,
hybrid model, exactly. And we're seeing it with smaller groups of younger, either professionals that were in M&A or people that were in the business, and they're kind of coming together and grouping some financing and looking at ways to leverage debt and equity in that model to buy up smaller companies and kind of grow that way. So we're seeing that in the marketplace, which,
So,
5, 7 years ago, we might not have seen that as much.
Yeah.
so there's a whole market, to speak to Bill's point. There's a whole market that emerged in the last 5 years. It's either you call them, we used to call them fundless sponsors. Independent sponsors is now sort of more the trend, or search funds. I think
mm,
that's sort of what you're speaking to, and they're everywhere. They're recent graduates from B school. There's courses that entrepreneurship via acquisition, and they're coming out and they're looking for an opportunity to buy the company. And most, at least what we've seen, many of them don't have their own sources of capital, so they're
mm,
out talking to different, debt and equity sources to try to fund the opportunity. So I caution business owners who are listening to us about those groups. We will only engage those groups if they have industry experience, if they have domain expertise, they've actually got a track record. So they've taken a company like yours and they've actually run a company and they've had a good process and a good exit, and they bring their own capital. They need to bring a minimum of $1 million to the party. We looked at a deal where, two people brought us a deal. It was a bicycle manufacturer, and what they knew about the bicycle was they knew how to ride a bicycle. And that was the extent of it. And we said, thanks. We also know how to ride a bicycle. Just introduce us to the buyer, to the owner who wants to sell the company, and we'll work with that. We'll work with that owner directly and try to facilitate something and give you a small fee for your trouble. So it's just, I caution the audience that they're out there. There may be some search funds listening and they may have a different perspective, but that's a lot of what, when we're in private equity with a closed-end fund, we find this is very interesting because there are a lot of companies that are seeking to be acquired. There's a lot of succession planning that isn't happening. Less than 30% of companies don't really have a plan to exit. And so I think there's those kinds of things that are just interesting, that are, key factors that I think are to be mindful of.
Yeah, and I agree with you 100%. I mean, we have to vet that buyer group significantly. And yeah, we do look for committed capital and kind of that individual experience, because a bank's not going to lend into somebody that's inexperienced. And if they don't have a fair amount of committed capital, it just ties up the company in a problem that they don't need. And that kind of gets back to working with the right advisors kind of upfront and understanding what those options are. Our sellers get calls all the time. For example, I'm working on one now that's a manufacturing company in Maine. He sends me every 3 days. He'll be like, let me introduce you to my advisor. And it's, one of these search firms inevitably just calling in and into his company to see if he'd be for sale, or, we have a potential, acquisition. So we deal with it a lot, and most of them aren't either in the space, qualified for the space, or have funding for it. But there are some good ones too. So I mean, we do,
Yeah,
and
that's
that's what we get paid to do, is to find the good ones and make
right.
if we are going to use them, that would be our job to vet them and get to that place. But
Yeah.
And actually, just to add my own word of caution, one thing that I've seen for the first time this year is this is more for the lower market, the smaller business market, but there are now M&A platforms out there that are, it's free for the seller to log into, and they have this access to all these buyers. The buyers pay. And on its face, it seems like it could be a really efficient way to get a deal done. But I had one client who just briefly entertained this option before coming to me. And when we dove into it, it's like, you really have no idea who these buyers are, how qualified. I mean, it's just rife with problems. But on their face, they seem pretty legitimate if you're not walking through this with an advisor. And so I just use that as a cautionary tale, that I think we'll see platforms like that, more AI-driven platforms, start to pop up that might seem nice and shiny on their face, but I think are just, rife with potential issues, especially when we talk about maximizing value and whatnot.
Just as it's important to prepare for seller's diligence, for the buyer, to make sure you have squeaky clean books and your processes are in place. You really have to be prepared, especially if you're going to entertain these independent sponsors, to vet them, like Bill said, and you may have to do some legal diligence on them as well, looking under their limited partnership agreements, or however their corporate structure is set up, looking at their financials in order to be in a position to determine whether or not they're qualified, even as a baseline question. Never mind whether or not you should enter into negotiations with them on actual terms.
Right. I think, sort of just a point on the PE type buyers, I think there's been a macro trend that we've seen, having just raised a fund, is that a lot of, I think on average, GPs are holding on to portfolio companies an additional 2 years. Because that's what we've heard from limited partners, when you're talking about limited partners are looking for liquidity and they're not seeing it. It's not coming back to them. So in our case, when we were raising the fund, they were like, we love what you're doing, but we haven't seen anything come back from the funds that we've invested in. Certainly on the buyout funds, they're a lot larger funds, but they've just been hanging on in part just because they're trying to still prep that company and get that ready, poised, and they don't feel like the growth is there. And so that's been an interesting trend that we noticed just when we were fundraising. And so that means sometimes I think the PE buyers, they don't have their capitals all tied up in their current portfolio that they haven't been able to successfully exit from. So that's another piece that we've seen.
Well, and that's a good segue. I recognize we only have about 5 minutes left, and I'm sure we could talk for hours about all this. But just to segue from that, in terms of the financing piece, how has access to capital changed over the past year, and where are buyers turning for financing today? So in other words, are traditional banks leading the market, or are private credit or alternative capital sources taking a bigger role. I know it's come up, already throughout this conversation that the financing component is at least more stable currently, and banks are more willing to put out money this year, which are all good signs. But what are your thoughts on where buyers should turn to for financing?
Yeah, I mean, I think in the case of strategics, they're usually coming because they have capital on their balance sheet that they're looking, they've got cash. So I think that's, it was our experience. I think in the case of the other two companies that we're exiting from, they're actually buying back their stock from us, and they're actually going out to look at senior lenders that have capacity to be able to essentially refinance so that they could actually get some money out of the business to be able to buy back the stock that we had bought. So we've been seeing a lot of ABL type lenders, because again, we do a lot of manufacturing type businesses. So we've seen a lot of ABL shops within the banks, but also a lot of private credit funds that have been raised in the last 5 years that are looking to deploy capital. So we've sort of seen those two groups in these deals.
And I think just to add an additional question to that piece, are financing sources becoming more industry selective, or are there certain sectors that are currently easier or harder to finance? I know, like last year, for example, the HVAC industry, banks were just throwing money at anything in the HVAC industry.
Yeah, a lot of roll-ups in that space.
Yeah.
Yeah, exactly.
Are there
I don't know,
sectors that come to mind?
Yeah, we have an opportunity also within the structure of our fund that I won't bore anyone with, but we have a lot of banks as limited partners in our fund, so we will often bring in a bank LP to help. And a lot of them, they will do a lot of different industries. A lot of them it seems like a lot of them like manufacturing when we ask them, like they like manufacturing, business services, construction, technology. I think they're less excited about retail or hospitality, because can be so customer and consumer dependent. And even in the consumer products industry, that can be difficult. That's what we're seeing. Bill, what do you think?
Yeah, I think that's right. Most of where we're in the range of the market that we're working in, we're usually seeing SBA transactions or senior lenders, depending on the collateral package and what that looks like and who the buyer is. But we are seeing, banks, asset-backed lenders are doing, the ABLs are doing, the manufacturing, and they obviously they like collateral. People like banks and lenders like collateral. So anything with collateral gives us an advantage. If there's a real estate component, a lot of times that is helpful. So the bigger the airball and the less contractual the customer side is, the more kind of national SBA type lending, or you need to get into some private lending sometimes to kind of bridge gaps or do those types of things. But overall, we're seeing, we're getting more and more of the national SBA lenders are doing a lot more. That it seems like they're much more active this year. Obviously, the SBA was closed at the end of last year. So that type of work was frozen up a little bit, or at least delayed. So we're seeing the senior lenders are pretty active and putting money out right now, more so than they had been. And so that's good. And I do think that sellers are more understanding of the gaps and things like that. And we have a lot more conversations around seller notes to bridge, or using equity from somewhere else to bridge gaps.
Well, I see Mike's popped back on, which means we're just about out of time. And I'd like to add or end it on a positive note, which I feel like we've gotten a few positive tidbits on the financing climate, which is great for our audience to keep in mind as they forge ahead this year.
Thanks, Emily, and thanks, Eric, Bill, and Karen, and thanks for our sponsor, Sheehan Phinney. And by tomorrow, you should have an email in your inbox with a recording of this conversation. So thank you very much for spending time with us.
Thank you.
Thank you.
Thank you all. Thank you.
Appreciate it. Thank you.